Here's the thing about getting one part of your tax right. It can make you feel like you've got all of it right. You've crossed 100,000. You know about the personal allowance taper. You've sorted your pension contributions. You've protected your allowance. And honestly, you should feel good about that. Most people earning at your level haven't done what you've done. But there's a second layer. Quieter than the 60% trap, less talked about, and in some cases just as expensive over time. These are the mistakes that survive the fix. They sit underneath. They don't announce themselves. Fixing the 60% trap isn't the end. For the people who get this completely right, it's the beginning. My name is Mark. Welcome back to Wealth Architecture. This one surprises people because at first glance, it sounds like it doesn't apply to them. The high-income child benefit charge. Most people earning above 100,000 assume this is irrelevant. It was resolved years ago, back when their income first crossed 60,000. Here's what they've missed. If your pension contributions have brought your adjusted net income back below 60,000, you may now be eligible for child benefit you stopped claiming years ago. The charge starts at 60,000. Below that, you get the full benefit. High-income child benefit charge, 2026/27. Below £60,000, ANI. No charge, full child benefit. £60,000 to £80,000. 1% charge per £200 over £60,000. Above £80,000, full clawback, no benefit retained. Current rates: £27.05 per week for first child, £17.90 per week for each additional child. The pension contribution that reduces your ANI below 60,000 doesn't just save you tax. For families with children, it can restore a benefit you thought was permanently gone. You cannot backdate claims, so if your contributions have already brought you below the threshold and you stopped claiming, restart now. That's not a complicated action, but it's one most people don't know to take. We've talked about the personal allowance taper throughout this series. There's a second taper, and far fewer people know it exists: the pension annual allowance taper. The standard pension annual allowance is £60,000. But if your adjusted income, which is different from adjusted net income and includes employer pension contributions, exceeds £260,000, your allowance starts to reduce. For every £2 above that threshold, you lose £1 of annual allowance. Pension Annual Allowance Taper, 2026/27. Threshold income, £200,000 before pension contributions. Adjusted income, £260,000. Income plus all pension contributions. Taper, £1 lost per £2 above threshold. Minimum allowance, £10,000. Most people watching this aren't close to $260,000 in adjusted income. But those who are, particularly those receiving large employer pension contributions as part of a senior package, need to calculate their position before making contributions this year. Breaching the annual allowance unknowingly creates a tax charge at your marginal rate. That's not a small number. This is one of the most expensive silent mistakes on this list. As savings and investments grow, more high earners find themselves with meaningful income sitting outside their pension and ISA wrappers. And this creates tax liabilities that accumulate quietly. Higher rate taxpayers get £500 of interest income tax-free per year. Beyond that, savings interest is taxable at 40%. Dividend income above the £500 dividend allowance is taxed at 33 1/3%. If you have savings or investments outside a wrapper and your interest or dividend income exceeds these allowances, you have a tax liability. Most people know this in theory. Very few have calculated what it actually amounts to in their situation. Fewer still have restructured to minimize it. The solution isn't clever, it's structural. Move income-producing investments inside ISA and pension wrappers wherever possible. What sits outside should, where practical, be growth-focused rather than income-producing. The annual capital gains tax exempt amount is £3,000 for 2026/27. £3,000 of gains can be realised and reinvested tax-free every single year. Most high earners don't use it. They hold their assets, watch them grow, and build a capital gains tax liability for the future without realising it. Not using the exemption is not neutral. It's deferring a tax bill that grows as the asset grows. Capital gains tax, key figures, 2026/27. Annual exempt amount, £3,000. Higher rate capital gains tax, 24% on most assets, 24% on residential property. Business asset disposal relief, 18%. Unused exemptions cannot be carried forward. Reset on April 5th. Use the exemption every year. Sell, crystallize the gain within your allowance, and reinvest. It's not complex. It takes one decision per year. The window closes every April 5th. When it closes, it's gone. Every mistake in this video follows the same pattern as every mistake in this series. These aren't obscure. They aren't edge cases. They're mainstream features of the UK tax system that apply to anyone earning above £100,000. They're hidden not because they're complex. They're hidden because nobody is actively looking for them. The 60% trap gets attention because it's dramatic. The child benefit charge, the tapered allowance, the savings tax, the capital gains tax exemption. They're quieter. Quieter doesn't mean cheaper. Over a career, the quiet mistakes often cost more than the loud ones. Because they're never addressed, they just continue. 4 things to check today. Right now, if you can. 1. If you have children and your adjusted net income is anywhere near £60,000 after pension contributions, recalculate your child benefit position. You may be entitled to benefits you stopped claiming. You cannot backdate, so act promptly. 2. If your total income, including employer pension contributions, could be approaching £260,000, calculate your tapered annual allowance before making any contributions this year. The charge for breaching it is significant, and employers don't always flag it. 3. Check any savings and investments sitting outside your ISA and pension. If interest or dividend income is meaningfully above the allowances, consider restructuring before next April. 4. Check whether you have any capital gains tax exemption left this year. £3,000 of gains can be realised tax-free. That window closes April 5th. The expansion tier. What you now know. Video 6. How to eliminate the 60% rate entirely. Video 7. How to manage salary, bonus, and pension together. Video 8. The 5 most common overpayment mistakes. Video 9. How salary sacrifice works and when to use it. Video 10. The hidden mistakes that persist after the obvious fix. That's the foundation built, the expansion complete. From video 11, we go deeper. The next video is for a specific group, those earning above £120,000. The approach that works at £105,000 is not the approach that works here. The levers are the same, the stakes are higher, and the decisions most people at that level are still getting wrong might surprise you. Subscribe. Tell someone who earns well but hasn't looked at this properly. There's always someone like that. See you in the next one.